Welcome to another edition of the Trading Script. Markets in motion. Today is Wednesday, September 18th. The Fed cut rates, and by 50 basis points, no less. So what's next for the market? Is this the proverbial top for the SPY? Well, according to the bond market, not quite. And although we may have our opinions regarding the economy and whatnot, the best we can do is look at some charts and see what most investors with their own money are thinking. Let's start this time with the HYG chart. Again, this is a weekly chart, so we'll have to wait until the close on Friday to confirm if this breakout is all that it seems, which, until proven otherwise, is announcing more upside in the market. However, a word of caution, this is, again, the weekly chart, meaning that each bar is comprised of at least 5 trading days. Therefore, whatever happens here, even if it is more upside, will take time to develop. It's just not going to happen tomorrow, folks. Also, within this range, the market can still pull back or consolidate for some time. For some perspective, imagine that one of these candles could represent 5 days of the market losing some ground. Not a pretty picture. This is all just to say that from our point of view, at least, this isn't the time to start loading the wagon, so to speak, since in the weeks ahead, we could still see some distribution or repositioning from investors before the next leg up in the market. But why, you may ask? Why doesn't the market just keep marching higher for the rest of the month? Well, once again, we need to take a look at the VIX. And what is the VIX telling us? To start, it hasn't broken its uptrend, meaning that investors are still nervous. However, it's also true that, at least on a closing basis, the SPY hasn't made a new all-time high yet, which of course may still happen tomorrow. But why do we even mention this? Once again, as we've been repeating on this channel, there is a certain level of synchronization in the market and across multiple assets. For example, let's look this time at a very iconic stock, Caterpillar. And why Caterpillar? Because this is a stock that a lot of institutions hold, regarded also as a solid retirement stock. So, although it doesn't reflect the whole market, it can give us some clues as to what institutions may be thinking. For example, we can see that CAT has broken this trend line, also known in trading as a bullish breakout, which quite simply means that more upside remains ahead. But again, this won't happen overnight, for the simple reason that the VIX hasn't broken to a new relative low, and as long as investors remain cautious or even fearful, it will be very difficult for any stock to make a new high. Nevertheless, because CAT successfully broke this trend line today, the door remains open for a second attempt to the upside, meaning another attempt for the SPY to close with a new high. So, what is the conclusion of all this, at least thus far? Well, if nothing changes, the charts are telling us that the market still has some room to run in the months ahead, possibly into next year. But because of extended momentum and the fear that still lingers in the minds of investors, we shouldn't expect the SPY to simply go up from here without any pause, which quite simply translates into not taking unnecessary risks, thinking that stocks will just keep rallying non-stop without taking a breather. So for now, we'll have to wait and see if the SPY makes a new high tomorrow on a closing basis. And also check if the VIX will finally break its uptrend. Otherwise, we need to remain cautious. Thanks for watching, and don't forget to comment and subscribe as we bring you more videos on market and technical analysis.